Welcome to the Deep Dive, the Talk Ticker Special, where we give you the essential, high-impact knowledge you need from the quarter's most crucial earnings calls.
And today, we're jumping into Corsair Gaming, specifically their Q2 2025 results.
That's right. The call happened after hours, August 7th. And, well, it set up an interesting market reaction.
Yeah, definitely. You had strong revenue, really impressive margin improvements, too.
But there was this big question mark hanging over the profit outlook, wasn't there?
Exactly. It was a bit of a classic good news, bad news situation for the market to digest. Operationally, things looked strong.
Very strong.
But that forward look on profitability, it got kind of obscured by some of those bigger macro factors.
And the market reaction reflected that, right? Just a modest bump the next day.
Yeah, it suggests investors were weighing things carefully, balancing that clear top-line momentum against the uncertainty around guidance.
Okay, let's unpack this for you. Starting with the headline numbers, the snapshot. Revenue first.
Yeah, revenue looked great.
Corsair really delivered here. They reported $320.1 million in Q2. That's up a massive 23% year over year.
23%. Huge growth.
And importantly, it beat the Wall Street consensus. They were looking for about $311.1 million, so a beat of roughly $9 million.
That's a very solid beat. It really confirms that demand for those high-end PC components, it's definitely back.
Okay, so the top line is strong, robust, as you said, but profitability.
Right.
That's where the tension starts, isn't it?
That's right. So their non-GAAP earnings per share, think of that as their kind of operational earnings that came in at 0.11.
1 cent. And the street was expecting.
Consensus was 0 to 3 cents. So a miss by 2 cents.
And the official GAAP EPS.
That was actually a loss, 16 cents per share in the red, $2.16.
Okay, so that miss, that's likely what the market zeroed in on initially. Why the difference? Why did the street expect $2.03?
Well, analysts were probably modeling a faster conversion of that great revenue growth straight down to the bottom line, maybe assuming slightly better cost control kicking in already.
So the miss suggests costs, maybe cost of goods or operating expenses, just rose a bit faster than they thought.
Could be. Or maybe product mix, early investment, something like that. But, you got to look deeper because there's a definite silver lining here.
Ah, yes, the leverage.
Huge financial leverage showing up in the margins.
And that margin story is impressive. Gross margin expanded 270 basis points year over year, hit 26.8%.
Yeah, 270 basis points.
For listeners maybe not tracking basis points every day, put that in context. What's 270 mean practically?
Okay, think of it like this. 100 basis points is 1%. So 270 is a 2.7 percentage point jump in their profit before operating expenses.
That's a really significant improvement.
It is. It signals, better operational health, maybe better pricing power. They're selling a richer mix of high margin stuff, or their cost controls are really starting to bite effectively, or both.
And that improved gross margin, that's what drove the adjusted EBITDA comeback, right?
Exactly. That figure really confirms the momentum shift. They posted $8.1 million in adjusted EBITDA.
Which is a huge turnaround from the loss they had last year, which was about $1.2 million.
Massive positive swing. It really demonstrates they've reestablished profitability at the operational level. The core business is making money again before those other items.
So the internal machine manufacturing, inventory, product mix seems to be humming along nicely.
Yeah, it suggests that. The issue, it seems, was just converting that strong gross profit all the way down to the net income line quite fast enough to meet those analyst expectations for this specific quarter.
Okay, let's dig into what is driving this growth, the segment performance.
Yeah.
Because the two main business units, they grew at really different speeds.
Yeah, very different. It makes it pretty clear where the current market cycle is focused.
And the action is squarely in that core PC builder enthusiast market, isn't it?
Absolutely. The gaming components and systems segment, it delivered a staggering 30% revenue growth year over year.
30%. Wow, okay, compare that to the other side.
The gamer peripherals and creator segment, that grew too, a solid 9% year over year. But, obviously much lower than the component side.
Right. So that 30% surge in components, that's really the headline driver here. We've talked about the cycle coming. What did management point to specifically causing this explosion in demand right now?
It's the big one. the generational GPU upgrade cycle. Plain and simple.
NVIDIA 5000, AMD 9000 series.
Exactly. There's massive enthusiasm around those new launches. And when gamers or creators slot those powerful new graphics cards in, well, it immediately shows up the weak points in their older systems.
Right, the bottlenecks. And those bottlenecks aren't usually your mouse or keyboard, are they? It's the guts of the machine.
Precisely. It's the power source and the cooling. These new high-end GPUs, they draw dramatically more power. So boom, you need a new high-wattage power supply, a PSU.
Corsair sells those.
They do. And at the same time, all that power generates way more heat. So you need better cooling, often liquid cooling systems now.
Which Corsair also sells.
Yep. And if you're driving high-resolution gaming or streaming or doing AI work, you need faster memory modules too.
Also Corsair.
Also Corsair. It's this multi-stage refresh. High-margin components lead the way, and management sort of expects the peripherals, the keyboards, mice, headsets that demand will follow later, maybe as new big games launch and people fully optimize their setups.
Okay, let's shift to that peripherals and creator side then. Even at 9% growth, the creator economy part, powered by Elgato, seems to have its own steady beat.
Elgato is definitely the anchor there, still dominates that space. Demand for their stuff, like the Stream Deck, video capture cards, it's still really robust.
Any specific drivers they called out for Elgato this quarter?
Yeah, interesting little tailwind. They mentioned the Nintendo Switch 2 launch late in Q2 actually generated a wave of new content creation, people wanting to capture gameplay.
Makes sense. More capture demand.
Exactly. Plus, they keep launching new products, like the Facecam 4K, which helps keep them ahead.
Speaking of new products and sort of strategic positioning, they seem pretty active in trying to push the brand beyond just the core gamer. Let's talk about that ORIGIN PC AI Workstation 300.
Right, the AI Workstation. That feels like a significant strategic move.
Yeah.
Definitely moves the story beyond just gaming.
What's the angle there? It's a compact system, right?
Yeah, small form factor.
Right.
And it's specifically targeting running large language models, LLMs locally, also for AI development, advanced creative work.
Okay, for our listener, why local LLMs? Isn't most AI stuff done up in the cloud somewhere?
A lot is, yeah. But being able to run these models right on your desktop locally, it's becoming really important for certain things, like low latency development, or if you're working with sensitive proprietary data, security is a big factor.
So Corsair is basically leveraging the high-end components they already make.
Exactly. GPUs, power, cooling, leveraging that expertise to push into a new kind of professional developer market. It potentially expands their total addressable market, positioning them to maybe catch some of that huge wave of AI growth.
Interesting pivot. And we also saw the integration of Fanatec starting their sim racing acquisition, another new growth path.
That's the other key diversification play, yeah. Management said they saw an early, encouraging ramp up of Fanatec products going through their own channel partners late in Q2.
So using Corsair's distribution muscle.
Right, that's the synergy play. Moving Fanatec onto Corsair's, frankly, superior global logistics and distribution network, the plan seems to be getting new combined products out later this year, shows they're pretty bullish on that sim racing category.
And it fits with that cross-brand synergy idea, like putting the virtual Stream Deck software onto their Scimitar mouse.
Yeah, connecting the ecosystems. Makes sense.
Okay, before we hit the guidance piece, just quickly on the balance sheet, looked like good discipline there. What was the main message on debt?
Yeah, they seem focused on de-risking, getting ready for future growth. The CFO highlighted proactive management. They paid down another $24 million on their term loan in Q2.
Yeah.
And then in July, they quickly refinanced their entire credit facility. If you zoom out, the debt reduction story is actually pretty impressive since their IPO.
How much have they brought it down?
Face value debt was around $550 million back then. Now it's down to $125 million.
Wow, that's significant deleveraging.
It is. Frees up cash flow, makes them more flexible, maybe positions them for future M&A if the right deal comes along.
Okay, that strong internal management, that debt reduction, it's a good backdrop for the investor context. The outlook, which got complicated.
Very complicated.
They reaffirmed the full-year revenue outlook, kept that wide range, $1.4 billion to $1.6 billion, but they pulled profitability guidance entirely. Adjusted operating income, adjusted EBITDA targets.
Gone. Yeah, just withdrew them.
Why? Why the sudden caution when revenue's tracking well, margins are improving? What happened?
This is really the core issue, the reason for that market tension we talked about. The answer is tariffs, global supply chain risks.
Why?
Management basically said they have a severe lack of visibility right now about potential new tariffs, specifically country-specific ones or maybe sectoral semiconductor tariffs.
That makes forecasting profit almost impossible if you don't know your input costs or potential duties.
Exactly. They did say they're actively working on mitigation, shifting supply chains, finding new vendors, flexibility, but they were very clear with the market. There's going to be a lag.
A lag between tariffs hitting and mitigation working.
Right. The benefits of those mitigation efforts, they won't fully show up for maybe several quarters. So any new tariffs imposed in the short term will hit margins, and they just can't reliably quantify that impact yet.
So until they get better visibility, they just decided not to put out potentially inaccurate profit targets.
Seems to be the case. They pulled the updated adjusted operating income and adjusted EBITDA guidance.
So as an investor, you're left looking at great operational signs, that 30% component growth, those expanding margins, but with this huge geopolitical risk clouding the actual bottom line forecast.
Right. Yep. And that tension really explains that muted market reaction. Just that, 1.92% bump the next day. Investors are clearly prioritizing certainty right now, even over strong underlying momentum.
Makes sense. And the CEO's priorities reflect that focus on controlling what they can control, right?
Absolutely. He laid out 3 core priorities. Keep accelerating new product innovation, drive margin expansion through efficiencies and getting those M&A synergies working, and third, channel expansion, especially into places like Asia where they feel underserved, and also scaling up their own direct-to-consumer business.
Trying to build resilience internally while navigating that external fog.
That's the game plan, it looks like.
All right, let's pivot. Time for the section where we bat around some potential trade ideas based on this earnings print. And just the usual reminder.
This is not financial advice, purely discussion, strategic thinking based on the data.
Exactly. So the narrative you could build here, it feels like one of potential undervaluation, doesn't it?
You could argue that, yeah. The bullish case really hinges on converting that hardware momentum, that strong revenue, into actual free cash flow, riding that favorable GPU cycle.
And the main thing holding the stock back, arguably, is entirely external. It's that unpredictable tariff situation, stopping them from giving updated EBITDA guidance.
Right. The market seems to be valuing the certainty of the tariff risk more heavily than the reality of that 30% segment growth right now.
Which creates a potential arbitrage, maybe, if you believe that component cycle has legs.
That's the bet.
Okay, pitch committee.
Yeah.
Here's my outrageous but plausible trade idea. You initiate a long position now or soon.
Okay.
But your catalyst window isn't immediate. You're looking out towards Q4 results, which would land early next year.
So patience required? What's the trigger?
The bet is that the organic demand, driven by that component segment, is just too strong to be suppressed by tariff uncertainty indefinitely. You're betting on the sheer force of the revenue growth.
So you think strong revenue will eventually force their hand on guidance?
Kind of. You focus on the high end of that revenue guidance, they reaffirmed the $1.6 billion. If their Q3 results, and then especially the holiday Q4 sell-through data, show they are clearly tracking towards that $1.6 billion.
Driven by that roaring component engine.
Exactly. If that engine keeps roaring through the holidays, it becomes, I think, really difficult for management not to provide an updated positive EBITDA outlook, even if some tariff uncertainty remains.
Because the underlying operational health, that 270 basis point margin expansion they already showed, would be undeniable at that revenue level.
Precisely. The strong performance would basically force a profitability guidance update. And that update could unlock a lot of the investor enthusiasm that got put on hold this quarter because of the uncertainty.
It's definitely high risk, high reward. You're essentially betting that the internal business strength powered by the GPU cycle eventually outweighs the external political risk, probably by year end or early next year.
Leading to a potential stock re-rating once that profit picture gets even a little bit clearer. That's the trade pitch.
Okay. Provocative. So wrapping up the call overall, the main takeaway feels pretty clear, right?
Yeah, I think so. Corsair showed really strong revenue growth. Impressive margin expansion, too, mostly driven by that component upgrade cycle.
The EPS miss, and especially those tariff visibility issues, they injected just enough short-term doubt to keep a lid on the valuation for now.
And as we think longer term, that diversification push, like that ORIGIN PC AI Workstation, it leads to a final question for you to chew on.
Okay.
Can Corsair, a brand built fundamentally on gaming and enthusiast parts, truly break into the professional AI development space with this kind of product? They're up against giants like Dell and HP in the professional workstation market.
Right. Will this AI system establish a real foothold, or will it just end up being kind of niche, high-end product for existing enthusiasts who also dabble in AI?
Can they genuinely capture a whole new professional market segment?
That's the multi-year test, isn't it? Whether they can successfully execute that strategic pivot beyond their core niche, that'll be fascinating to watch.
Indeed it will. Thanks for joining us for this deep dive into the Corsair call. And remember, everything we talked about today,
It's for educational and discussion purposes only. This is not financial advice. Always do your own homework.